Dude, honestly, what a pump into FOMC here on the Nasdaq.
Yeah. I mean, why though? Why did we even pump that much? There was no surprises, nothing really came out that would really cause something like that. Like what why even did we get such a fat gap up? I mean, we had earnings misses yesterday too, but we reversed from that.
Yeah. I think honestly the driver for this, and I did post about this. I'm sure you read about it, but the commodities being like, if we take a look at GSG and what it did today, like obviously monster day, right? The monster up candle, but some people will be like, oh, that's the FOMC or whatever. It really wasn't, right? Equities aren't up because of the FOMC. Like if we look at QQQ based on what happened after FOMC, like you'll notice like FOMC drops here, what, at right here, right?
Yep.
So 470. Like we were already gapped up into that. We didn't gap up because of that, right?
Yeah.
And I'm thinking like what I have found to be the driver, at least at the moment, is commodities. So what happened is obviously commodities were up at the open. They grind higher into FOMC, and then we had some late day um, bombing headlines hit the tape, and it kind of took off from there. But ultimately, what's going on here, I think, at least with equities, into the earnings reports was this idea that like when commodities go down like this, and we're talking like 45-degree angle, like every day, right, down. I think that the market started getting at least worried on the surface that there might be some concern of growth, right? Because like if commodities are dropping like this, look, there's a certain point where where it's disinflation and it's acceptable, right? Like slowing inflation, moderating growth, but still strong. And then you get the situation where like you fall into the territory of like negative inflation, negative growth, which is what we call deflation, right? And that's like not a hard set line. There's no fine line in commodities that defines where that pivot takes place. But I think when you fall consistently like this in commodities, in again a straight line, the market starts getting spooked out, and we saw that with QQQ,
Yeah.
right?
And
Like
and
all
so
of it, like it took.
basically that we just got reaffirmed that that's what the market is looking at right now. When we saw that bounce in commodities and it caused equities to bounce with it, that basically reaffirmed like the market thinks that there's a growth slowdown that's causing these commodity prices. It's no longer just inflationary or um, disinflationary pressures anymore. Now we're down to growth affecting it.
Yeah, we've been pretty clear on that though, right? For like at least a year now, where growth is the in the driver's seat and has been for months now, right? So if growth does fall from here, it's going to be the main concern, right? Disinflation falling is at this point, I think the market believes to the extent disinflation has made enough progress, and we heard that in the FOMC speech today, where Powell basically said inflation has gotten down to the point where it's at the same level of concern as employment, meaning essentially inflation was the main concern throughout this hiking cycle up until this point. I don't want to say this exact point, but the last couple of months where disinflation proved to be resilient after bouncing up in the end of Q1 or middle of Q2, however you want to put it. And now we're back down. So the idea is okay, disinflation seems more robust than we might have initially thought with that hiccup. And now it's just on employment. And we're going to have those NFP numbers later this week on Friday. And we're going to get to see where the unemployment rate uh, prints. It's at 4.1% right now. Historically, it's very tight. And I think this is like a big thing, right? Like everyone's like, oh, India labor market's weakening, right? It is. And people are like, okay, recession is coming. I think that's where you have to draw the line. And I think that's where we have been drawing the line in the sense that a recession and a slowdown are not the same, right?
Yeah.
The, the
Powell
idea,
even uh, highlighted that today at FOMC, basically saying that they don't see a hard landing happening. I think they're
which is
more
interesting,
so.
right?
Yeah, they're pretty much dead set on the soft landing now.
I know. Isn't that a little scary? Don't you
It
think that
is a
might be
little
like,
scary. It's like,
yeah, right?
well, we haven't tweeted in a while, but I remember we used to tweet like the last people that will capitulate is the Fed. When they say, "Oh, we're in the clear, we're good," that's when shit's gonna hit the fan.
Right.
Do you
Yeah,
still
I
think that
can
that's a
understand.
possibility?
I think that so yeah, that is a possibility, but again, the question comes down to the acceleration in unemployment. So what I found really interesting today was how Powell basically alluded to the fact that um, the lags have started appearing in the last 6 months, right? He basically one of the lines of saying lags are starting to emerge over the last 6 months and pointed to the weakness in unemployment, right? This uptick in weakness in labor, uptick in unemployment. And well, okay, if the hiking cycle that's been going on since 2022 is well underway now, and the lags are very noticeable the last 6 months, what are the what's up, what's in store for the next 6 months, right? Like how much more of lag have we not seen yet,
Mm,
right? And then
yeah.
you have to ask yourself, okay, does that mean that we get this situation where employment gradually creeps up, like, or grinds higher, I should say, unemployment, right? Labor market is loosening, but at a steady pace. It's not really ripping. I don't want to. It's not really falling off a cliff, right? Uh, Unemployment rate's not ripping. That point, then yeah, the soft landing becomes more and more like feasible because the Fed will obviously be easing into that. As we heard today, literally any more weakness in unemployment, and I think I think you can pretty much, if we get a moderate inline slash subpar unemployment print on Friday, I almost think it's a lock for September, unless something drastically changes in the August. I mean, in the September print. Sorry.
Yeah. But so historically, has has it ever happened where unemployment just gradually grinds up and then reverses and we get that soft landing scenario? Has that ever actually happened? Or does it always just get out of control and then the Fed is put in a position where they need to panic?
Well, it really depends. Like again, there's a long ways up to the historic levels from where we are right now. Again, signaling that we're somewhat the employment scenario or environment's coming back into balance, as Powell said, which makes sense. I mean, if you look at the unemployment rate, we're at 4.1. I mean, all the peaks of the prior slowdown slash recessions were much higher. I mean, even the dot-com peak, which is the lowest one out of the major prior four, right, is at 6.3%. So this isn't to say like, oh, like the Fed's going to wait until 5-6% before they cut rates, but this idea that we can just pitter patter between 4 and 5 or whatnot, it's not out of the question. I wouldn't say it's impossible, but I think what adds a very big if to the statement, if we can do it, is the fact that the Fed is going to have to start easing rates at least marginally, because we know it's the game of the Fed is not about one interest rate hike or one interest rate cut, but it's about the gradual path to accommodative policy, right? So if policy is restrictive right now, the first question is to figure out if you're going to leave restrictive state, and then the second question is, where is the path of normalization? Is it at 3.5% for the Fed funds rate? Is it at 2.5%? I mean, again, if we look at inflation going back, and better yet, I actually have a chart here that shows gross domestic product, which is GDP, and CPI. And GDP is measured year over year. So same as CPI, right? And a lot of people are saying like, oh, economy is way hotter in this post-COVID environment. We need a higher neutral rate. We need a higher whatever it may be. The Fed is not actually restrictive. It's just moderate, right? And my case against that, I should say, is like GDP is pretty much back to where we were in 2020, what is it, 2018? 20, yeah, late Q3 20, Q2, Q3 2018, right? That's where GDP on a nominal basis is back. Inflation is pretty much on the verge of getting back to the 2018 peak. So in terms of growth and inflation, we're back to 2018-ish area. I mean, we're on the upper end for sure. We're not really like significantly below those levels, but we're back, right? To
Yeah,
those
and I
points.
mean,
So the
GDP is also at the levels we saw in the 90s. So it's not like we're running super hot right now.
Right, but the question is okay, so for example, the GDP in the 90s, right? Let's just take this five line and go back. The GDP in the 90s was running a bit stronger and a bit higher, right? It really didn't go under the five line. It kind of tapped it and went above. Could we be in a new dynamic where it doesn't go below 5% nominal GDP and we just kind of trend higher? I think that would be a merit of, look, something's changed. But we haven't seen enough evidence for that yet. So we kind of have to go an assumption on what has been will continue, right? The
Hmm.
idea that the post GFC environment was a bit different. Number one being inflation expectations, right? That post GFC is where the Federal Reserve implemented the 2% inflation target, right? So after the GFC, term premiums went to pretty much went down the gutter. Some will argue it's QE. To a degree, yeah, QE was a factor in that, but the other factor behind term premium is, which is the basically the premium on long duration on a long duration bond. When we talk about term premium, we're talking long duration, and the premium or discount on that based on uncertainty, right? You have to get paid to hold duration. So the term premium has been pretty much flat to non-existent, and I'll even pull up a chart here. And the reason for that, in my opinion, it's surrounding the fact that there's an inflation target now, and the Fed's been pretty much glued to it compared to this post GFC environment where there was no direction on inflation to the degree there is today. So I think term premiums get eviscerated in an environment where ultimately over time people believe the Fed to rein inflation in, right? So I think that's one factor that kind of has to put us in a position where we have to assume the post GFC environment to a degree in terms of inflation is going to be the same, right? Because the Fed is not going to stop until inflation's at 2%. And ultimately, like they will cause a recession to get there. Realistically, like they'll rather stay too high for too long, really over tighten the economy to make sure that inflation does settle at or around 2%. Now, one interest rate cut's not going to do much. We know that, right? But the idea is like, okay, if the target's still 2% there, and nominal GDP, excuse me, is not like viciously higher compared to what we saw back in the 2010s to 2020s. Well, then you have to assume that maybe disinflation does continue here, and maybe we get back down to target a lot sooner than everyone expects, and the Fed is in fact in an overly restrictive state, and that's the dynamic that I think kind of is the big if in the soft landing, because I think for you to have a soft landing, right? And I'm sure you would agree, the based on the conditions we're seeing today and where the Fed is in terms of policy, because back in 2018 the Fed was at like 2.5, right? So if we look at back in 2018, two and a half, right? But right into 2019, so we're at five and a quarter now. So if this is so different, and you're going to bet on a soft landing, well, then you'd have to be making the assumption that the dynamic between growth and inflation has drastically changed in the new era, right?
Which is possible. I mean, we went through COVID, the whole COVID situation. It would be kind of naive to think that there isn't some structural changes that come out of that.
Exactly. Yeah, I agree with what you're saying, but I think we need the evidence to kind of give us. I don't want to sound like Powell, but we don't have enough data yet to confirm that we are in a different environment,
Yeah.
right? Like, I mean, GDP was thrown way down negative. What was it? Negative nominal was down -6%, then all the way up 16%, and it's just kind of come back down to normalize again at a level that's not so obscene to the 2018 era. Now, if we were normalizing, like let's say in the 10 to the 7 to 10% range, like we did see back in the 90s, I'd say, oh, okay, might be something got wrong, might be something different here. The Fed's supposedly restrictive, but GDP isn't going down, right? Question now is this print here from Q1 at 5.42% the bottom? Because if that's the bottom and we start accelerating higher from here, then I think the bond trade's gonna have problems, right? Because like you're really running into a position where the Fed isn't that restrictive. But so
Mm.
far, disinflation is slowing. We're seeing signs that the employment market or the labor market is slowing, or I shouldn't say disinflation is continuing, right? Um, Labor is slowing, and growth is moderating slash normalizing at a respectable rate. It's not really hot, but it's not that cold. Question now is how long does this work? Or how long does it stay here? And how long can the Fed sit pretty at 5.25 without being overly restrictive?
Yeah.
Right?
This could be the calm before the storm.
It
If
could.
if we do get that hard landing scenario, which I think that's the most likely scenario. There's no way you can go through this hiking cycle and expect everything to be fine. I mean, it could be wrong. There's been a lot of weird shit happening over the last few years, but it just doesn't seem realistic to be able to just come down from that. I mean, you're seeing other countries starting to suffer. Canada personally is not doing too hot. The job market is pretty much dried up. Unemployment's rising. The Bank of Canada is cutting rates because shit's starting to hit the fan, and I don't think America is immune to that. So I think
That's a
that
good
is
point.
the most likely scenario, but we'll have to see. We take it day by day, see how it goes. But let's pivot into bonds. We had a pretty good day on bonds today. Opened
Yeah.
with a nice gap up, and then even had a bit of a run after hours. So the bond trade is working, and like the saying that we have, one economic slip up and bonds rip up. I actually love that saying. It's super fun to say. But
Yeah, certainly.
we haven't had an economic slip up just yet. So we're not getting that bond rip up that we're expecting. Like kind of what we saw in December, that kind of steep incline is what I would be expecting from any economic slip up that happens. And who knows, maybe jobs numbers on Friday might be it. We'll have to see. I think those would actually affect bonds quite a bit more than FOMC. I feel like walking into this FOMC, people already knew what to expect. There was really no surprises.
Yeah, I mean, it was pretty much cemented for 25 basis points in September. The only rumor was, are they going to go 50? Right? That was really the only
Yeah.
misconception there, and that was ironed out pretty quickly by Powell.
Yeah.
Made it very clear that 25 is, 50 is going to be out of the question, obviously, unless the floor falls out of the economy, which, I mean, I can't see that happening in 45 days, but crazier things have happened, right? So, I mean, we'll have to see.
Yeah, you never
But
know.
ultimately, I think the bond trade, um, or the bond direction, the long bond direction has two components, right? So as we were saying earlier with the growth, right? And inflation. If that growth normalizes, if nominal GDP normalizes at a much higher rate and continues to run at a high rate, I think bonds do suffer because I think what ends up happening is the yield curve is going to have to revert to a bear steepener where the long end is priced way too low. And at that point, I think you would even see the Treasury, Janet Yellen, issuing more duration because it's a steal, right? Over time, it's a steal because you know that the Fed is maybe, like, for example, if the Fed's forecast to bring rates down to 3.5 and we normalize at this much higher rate, and we really do, then the idea is maybe we only have to go down to 4, 3.5, maybe even that's a little too low, right? 3.75, for example. Well, at that case, then the entire long end is going to get repriced higher, right? Not significantly, but then as the recession doesn't come, people, coupons are going to start getting issued, and there will be pressure on the long end. Now, I think the base case here is we're going to revert somewhere in the middle of pre and then post pandemic. So if we go back to the growth chart, we're going to revert somewhere between here, like this pre pandemic era, and the post pandemic era up here. So we'll probably revert in here for some time, unless the Fed really is in fact overly restrictive, and the bottom does fall out in the economy. And I think that there's a lot of underlying risk there that somewhat make bonds more attractive at the moment than equities. Look, the economy is going to grow, right? If it grows slow, it'll still theoretically grow unless you're in an actual recession. So a slowdown isn't the worst thing, unless it's a real deep slowdown. But I think that the dynamic there between the Fed at 5.25, where they are right now, inflation under 3%, real GDP where it was, to see if this gets revised down where it will be, and to claim that the Fed is not in a very, call it, firm restrictive state is foolish, right? I think, okay, you have to address the fact that they are restrictive. And if they are, then the question is, do they overstay their welcome? And the odds, like you just said earlier, are pretty high that they do. So I think that that's where the alpha is in bonds, because if they do overstay their welcome and they are overly restrictive, I think it's an easy bet to say the Fed's not bottoming at 3.5%, which is higher than where they peaked in 2018, right? Like, to say the Fed is going to bottom here on the chart, and that's going to be the end of the slowdown, bottom, call it the bottom of the of the trough in the economy and it reaccelerates, and the Fed is overly restrictive at the moment, I think that's foolish. I don't think that's right. And that's why I think bonds have that kind of asymmetrical upside, because even in a moderate slowdown, I don't even think in a slowdown 3.5. I mean, you'd have to finesse it, right? In my opinion. So I think that there's a possibility that, maybe the Fed bottoms at 2.5
Hmm.
or
An
3.
interesting thing, interesting question about at FOMC was if they make policy decisions based on the presidents, and
Mm.
they don't, which I mean, thankfully they don't. But I'm curious, what are your thoughts on a Trump presidency, which historically was good for growth? Growth became strong. Do you think that's a risk for the bond trade if he does come into office, does some shit to really make growth pop off, and they don't need to cut rates anymore?
Well, I think it depends on how you look at this, because I think all in all, my view is that the Fed's in a restrictive environment right now, regardless of president. I mean, it could be Joe Biden, Kamala Harris, Donald Trump, or Barack Obama. The president in the scope of the Fed's restrictiveness is kind of irrelevant. I think that if you look historically, the deficits, if you look at what presidents do during deficits, Trump's deficit is not nearly as bad when you take out the COVID spending, literally the lockdown spending from the pandemic. I think it's like around a 4% GDP deficit. So again, not crazy compared to the 7 to 8%, et cetera, deficit we've been seeing in the last couple of years. So I think that that's a positive for Trump, and if Trump were to be elected, in terms of this idea that spending does slow in terms of recent years. But ultimately, I think that the president isn't going to be so much a driver of bond yields at the moment, and I think it's really going to come down to the cycle, because the president's not going to be able to really stave off a recession, if you really think about it, without immense spending, right? And they have to come in and spend in the right places immediately. Pretty much, you know, fiscal QE, if you want to say it, like
Mm-hmm.
without Fed, because
Yeah.
the Fed is not going to do QE, and I want to talk about this um, quickly here. I put up this chart on X this week, and in a high level overview, this is basically what the reserves look like in the banking system. And right now, you basically have reserves plus the overnight repo at 21% of bank deposits. Okay. And about 2 or 3 months ago, Powell claimed that the current position of where this is was abundant. And the objective of this QT cycle is to bring reserves from abundant to ample. Now, unfortunately, the Fed has not made clear where ample is on this chart. But what they had made clear historically in 2019 was this level was considered scarce. So we know that the reserves target for the Fed for ample, the ample state, is somewhere in between abundant and scarce. And we're very close to abundant. So you could assume that QT likely continues here. And we also know, based on today's FOMC statement, that rate cuts are likely coming too. So it's a very interesting dynamic where we're going to see rate cuts and QT at the same time,
Mm, that's interesting.
right?
Now, how do you
Yeah,
think that would
that
affect equities and bonds?
I think that's an interesting dynamic, because you kind of like you throw you're throwing water on one of the tools, right? On one of the tools is on fire, and you're throwing water on the other one, essentially saying like one of them is not working, right? And I think that the Fed policy rate is obviously more of a tool than QE. Like this idea the balance sheet is support, adds liquidity to the economy, sure. But I think that if you run, so for example, if you're running QT and cutting rates, I think the rate cuts win in terms of easing, right? The rate cuts will overpower the QT, but the QT will just bring down the reserves in the system, adding more restrictiveness per se over time.
Yeah.
But not to the degree that rate cuts are offsetting. So theoretically, it's a net easing event, right? Net easing with kind of an offset in the QT department. But I don't think that, again, that's that material to stocks, because as long as growth is strong, GDP goes up, GDP goes up. I think earnings are good, stocks go up. And I think that you get into a situation like 2022 where GDP falls to the zero line and you don't know if you're in a recession or not. That's the worst, right? Because it's like You don't have that clear direction. Fortunately for us, though, I think it's very simple in stocks. So we just explained bonds, and we're going to finish up on stock. So stocks QQQ up under mid vamp here. It was at lower vamp earlier this week. We're still well above Momo. Bullish trend, very simple. We get back above mid vamp, which is what it looks like the post market session is indicating tomorrow's open is going to be. If we can hold above mid vamp, stocks can continue to trend up sideways slash higher. We think the highest probable chance or probable outcome in the stocks right now is chop. But if we're above mid vamp in a bullish trend, we have to accept the idea that new all-time highs are the base case. Okay. If we go under Momo, I think that's pretty much your indicator on the stock side of this whole equation. If you go under Momo, stocks become completely unfavorable, or I should say immediately unfavorable, because now you're looking at a possible bearish trend switch, and obviously you do not want to be long stocks in a bearish trend. Bonds, on the other hand, are bullish trend now. If they go bearish trend, our view on bonds will switch so quickly. We will be so against the bond trade. Just as we flipped into it, we will flip right out of it. That's how systematic trading works. And for those that don't know, we'll wrap this podcast up with that. Year-to-date stats, we are up 33.3% as of the July 31st close. That is 16.6% above the S&P's returns. Solid year so far with 2 red months and just a bunch of alpha. So if you guys want to see what we're doing to generate these returns, go to our website at market-radar.com or our Twitter at @themarketradar. Sign up for our quant deck and get the signals delivered directly to you every single day. Thank you.